Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. Once again, I'm here with my good friend, Doug Heagren. Hey, Doug.
Good morning, Kirk. Happy Halloween.
Awesome. Well, glad to have you. And, once again, we just have tons of data, tons of news. So let's just kind of dive right in. So, Doug, what are some of your thoughts? What should we talk about this week?
This weekend had an interesting conversation with a family member who I'll name nameless, but they were spending some time with some other individuals with the family. The kids in the family went out and they were looking at the menu, and kids being kids, right? So they ordered a little too much. They ordered an appetizer, but by the time the appetizer came, this was a Mexican restaurant. So you know what they do with those chips and salsa. It's irresistible, right? So the kids were slamming the chips and salsa. And all of a sudden the food comes and the kid touches one bite, two bites. And this person that took them out had a sizable reaction to it. Started talking about, don't have enough money. This is kind of the my budget for the week. I don't know, you kids need to be able to understand like how much this costs. And I think that's a good segue for what's going on right now, because this individual had recently retired. This person will get a pension, which puts them in a better situation than most people. But it's a pension that it's an offset, right? So it's not pension plus Social Security. This is their Social Security because they were a government worker, and then they retired with a 401k that I'm sure that they're looking at has just gotten obliterated, or a 403b that got obliterated, and then on top of that they got some medical costs. So I think right there, Craig or Kirk, we're talking about inflation, and we're talking about the impact that that's having on real people living real lives, trying to be able to afford to survive right now.
Yeah, I think that's a great point to start with, Doug, because I think, if you look at the last few years, COVID was rough on everybody for different reasons, right? But the government came in, printed a lot of money, gave it out to businesses, it gave it out to individuals. They gave a lot more to businesses than individuals, but of course, the businesses were sending that to their employees. So, money did get around. People can complain about whether it was a good use or bad use. Frankly, you can find fault in anything the government does. So I'm not going to sit here and throw rocks because it would be here all day. So, but I think the reality is that people have been struggling in the last few years. And yet at the same point, other people have not been struggling. So this wealth gap has widened. The people who have grown wealthier. If you look at, even though the tech companies have largely been hit really hard in the last year, prior to that, they were up an enormous amount. And I think was the NASDAQ up like 100% from the low of COVID? It was something crazy. That's not normal. And I think if you reflect back in 99, 98, the same thing happened for different reasons. And if you look at where we are now and where we're going, the dynamics are very, very different. And I think the thing that's really interesting to me is that I don't think people are awake to the fact that this paradigm is shifting. I think people are still a little asleep. They still have their COVID money. If you look at, the savings that people have, it was, sky high during COVID because all the money that went out, and it's starting to shrink, which is normal. But I think what's happening is costs are going up, and it hasn't impacted people in the same way because they still have savings that they're using. So they're still spending in the old paradigm, and yet we're in the new paradigm. So if all of a sudden, I know my food costs have gone up at least 100%. My gas costs to fill up my car have gone up at least 100%. And, it's just me, right? I can afford that, but most of the country can't. They can't afford doubling of their expenses. And of course, it's not all expenses that are doubled, but the ones that everyone needs, filling your car with gas, eating, things like that. Home costs have not gone up 100%, but they're definitely rising. And if you're buying a new house today, the payments that you're paying for the same house last year have pretty much doubled. So a lot of things have doubled. And yet people are still acting as if it's the old paradigm, and they think it's just going to go back to the way it was, and it's just not. And that's what we're going to talk about here today is When will this end? We'll get into that a little bit. What were you going to say, Doug?
Well, I was going to say when you talked about housing costs, so there's a gentleman that I followed on social media, Carly, I think it's car dealership guy, but he posted that someone that he's working with just got a car loan, has an 837 credit score, and Chase just approved him at their top rate of, I think it was like 7.6% for a car loan.
Yeah. It's a scary thought. I know. It's funny. I have two credit cards. I won't name them, but I have two credit cards. One's for business, one's for personal. The personal has always been the lowest. It was as low as I think 4.99%. I think was the lowest that
Which is
it got.
incredible.
Yeah, that was the lowest I've seen around. I haven't seen anything else that low, but I've had it for years and it was really good. So my credit's good, right? So I was able to get that. However, my business card, which I won't name, has never gone below just under 9%, like 8.99. That was the lowest I could get. Now it's up to, I think, 14 or 15%. And, I called them. I said, hey, what can you do? And they're like, oh, this is the lowest one we got. I'm like, what? What do you mean the lowest is 14 or 15%? They're like, yeah, it's the lowest we got. I'm like, you don't have business clients that are less than that? It's like, no, it's truly the best rate we got. So, it makes me wonder. I mean, there are a lot of people who are living off their credit cards. And if you're spending and paying it down every month, that's fine. I don't see any issue with that because you're not paying interest. But a lot of people are starting to carry a balance. So if you have savings, most likely you're going to, live off your savings. But once those are run dry, then people start taking out credit card loans, or they're still paying with their credit cards, but now they're running a balance. Well, that balance is now between 10 and 15% a year if you have good credit. If you don't have good credit, you might be up to 20, 25, 30%. I mean, depending on the state and the rules. How are you ever going to pay that off? You're not, right? I mean, that's the reality of it. You're never going to pay it off at that rate unless you come into money. And people who are carrying a balance most likely will not, especially in a recession. So we get back to the old advice that we said earlier. Is some simple advice is pay down your variable debt. If you have fixed debt, like a mortgage, you're fine. You have nothing to worry about. It's not going to change. You could have a 2% mortgage and we could have interest, the mortgage rates could go up to 20%. Doesn't matter because it doesn't affect you.
Mm-hmm.
Make sure your debt is fixed. Have it be a fixed rate. You can always refinance it if the rates go lower. But if they go higher, you're locked in. That's one of the benefits of a fixed rate. If you're in a variable rate, you're going to be in trouble because rates are going to keep going up, which we're going to talk about more in the show. But that to me is one of the simple things you could do. Spend less than you make, right? That's step one. Step two is get rid of your variable debt, because I think what you're going to see is this is not going away soon. Rates might drop for a little bit. If they start to drop, you're going to say, hey, you were wrong. No, I'm telling you right now, they're probably going to drop for a little bit. And then they're going to either stay where they are or they're going to go higher. And you just need to understand the fact that this is what is going to go on. So, don't get all excited if rates go down a little bit, because that is normal. If you look at the 70s, they went up and down a lot, but they still managed to go up to 20%. So just keep that in mind, that we're in for a long road. It's going to have ups and downs. You need to be prepared for both.
And Kirk, I'd like to add something. By the way, I want to say the private chat. I got someone named Jacob who says he loves the mask. So nice, Kirk.
Nice.
Keeping the spirit. So we're, I think another thing to think about. So I want to kind of add on to what you said. If you have non-deductible interest, if you have credit card interest, you have debt, that if you cannot pay it off right now, that is the definition of debt. The definition of debt is not your mortgage. It's not your car payment. I would argue it's not necessarily your student loans because of some various factors. If you do those things right, they are installment loans. They have a deadline and they have a schedule. But credit card, anytime you have purchased something that you cannot pay for in one payment, that you cannot pay for in more than one way other than to use future income, then you're in debt and you need to be putting money towards that right now. If you're putting extra money down on other things right now, like paying off your mortgage faster, I mean, if you're locked in at 2%, don't put money there, if you're trying to pay off your car payment faster, if you're trying to pay off student loans faster. Listen, right now, with Kirk and I have been talking about this paradigm shift. Remember, we've got a chairman for the Federal Reserve that has come out and said, with anger, I'm going to do everything I can to crush inflation. And that means taking the economy. So the number one place you need to be putting money right now is to pay off variable interest or non-deductible interest credit, like credit cards, because they're going to be subjected directly to what's going on with interest rates, and they are stealing from your future. The second thing you need to be doing right now is putting money in any place where it's liquid and accessible. Lack of accessibility to capital is the number one cause of financial stress. If you're putting extra money in your home thinking, I'm going to pay that off faster because I got to get rid of that, you can't get that back. You've turned your home into a qualified plan. You got to go to the bank and qualify. And right now, banks are going to be happy to give it back to you for a lot of loopholes you got to jump through, a lot of paperwork, and a lot of cost. That's not accessible. If you say, well, I'm putting it in the stock market, that's not accessible either because that drops by 25%. You don't want to go sell it then. That's the mistake. Everybody knows. Don't sell when it's down. Put money where it's not going to be affected by market volatility, where you can get to it without having to qualify. Because right now, that's the most important place to have it. Because if the chairman of the Federal Reserve has his way, he will successfully attack inflation if it's correct what he's trying to do. But he's going to do it by tanking the economy, which means elimination of jobs, means getting harder access to capital from banks. Be prepared by building up a pool of accessible funds right now. I just wanted to add that in, Kirk.
Yeah, appreciate that, Doug. Hey, Smart Money Tree podcast listeners. I live in this great state of Massachusetts. I think I may be the only person who calls it that, but I digress. The great state of Massachusetts has a commercial for the state lottery where they say, you can't win if you don't play. Now, for the moment, let's try to ignore the obvious implications that there is a state-sponsored ad that's suggesting you should go out and spend your hard-earned money gambling on lottery tickets with over 1 million to 1 odds of winning. But it's true. You can't win if you don't play. So I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. Actually, it doesn't cost you any money. I'm only asking for about 5 or 10 minutes of your time. But I will pay you at least 1 million Zim dollars for your time. Now, we do have some foreign listeners, so if you don't like dollars, we have some other currency as well. But if you do want to earn 1 million Zim dollars for 5 to 10 minutes of your time, please go to moneytreepodcast.com/free money. So we're going to talk a little bit about really the headline today, which is inflation, when will it end? So I'm going to lay out some predictions and some frameworks, and then we're going to talk about a few other stories to kind of lay some groundwork here. So I want to start with this. I've talked about this a lot in the show, and I'm going to lay it out again for those of you who are new to this, is inflation. The Fed has changed their tune on inflation quite a bit in the last year. They started out by saying it's not a big deal. Then they said it was transient. Then they said, well, it's not transient, but you'll be okay. And they keep changing the tune, which you should expect, right? This is what you should expect out of the government. Anytime the government says, don't worry, we're not going to default on our debt, you should be very, very afraid. You should do the exact opposite. Anything they say, it's to quell the markets, and it's usually right before they, decide to not pay their debt. So I think the way to look at it is we have inflation that is not directly tied to the amount of money printed. That is a factor to it, but it's not the reason. And I think we have to recognize the reason. And once you understand the reason, you'll understand why and when this thing will end. So the reason that we have high inflation now is mostly due to the supply chain. This started during COVID, right? And I'll give you some examples, talking to some contractors. So you're building a house, you're getting all sorts of materials. You're getting wood, you're getting metal, you're getting electronics, whatever. You're getting everything. So taking that as an example. Now, wood, right? Contractor needs wood to build a house. Well, during COVID, everything shut down, right? People weren't cutting down trees. But then you look at lumber prices, and they went through the roof. So lumber prices went from, I'm going to have to pull it up here, but if you here we go. So if you look at lumber prices, during COVID, I think they were somewhere around $400, per unit that they measure. Then it went up to 860, then went back down to 500, then went all the way up to 1700, then went back down to 470, then went up to 1500. Now it's back to 460. The point I'm making is that this is the bullwhip effect that we talked about in the past. Now, during COVID, they hit the low of 272. So what happens is nobody's cutting down trees. Of course, nobody's building houses, right? So it's just everything's neutral. However, when people start building houses again, they need more trees cut down, and they need it to be sent to the mill and cut for use, and all of the things in the chain. They have to move the wood. Once they cut it down, they have to move it to the mill and then move it to the Home Depot or whatever. The point is there's this supply chain, and it was messed up. So it caused high prices when they normally shouldn't be that high. And what we're seeing in the supply chain, lumber is an example, it's happening through every supply chain. And so and everybody I've talked to said this is going to require new manufacturing facilities, which will take 5 years to build. Now we're almost a year in. So pretty much at the early end, we have 4 years minimum before inflation is fixed. And that's assuming that the government doesn't make it worse. It's assuming that all these companies are hugely efficient and they get it done on time. And it's assuming that there's no external factors like a war with Russia or China or whoever. There's so many different variables in this. And I'm laying this out so you don't think, oh, well, he said X, so it's going to be X. So much can happen. So at the very earliest, you've got another four years and change before inflation ends. And if you add on the fact that the government's going to mess up, they're already talking about it. European governments have made it worse. They're saying, we're not going to let prices rise. Well, that means price fixing. And we saw how well that worked in the 70s. So that doesn't work. Now, if you look at, I've talked to a lot of really smart people that understand this way better than I said, we've got 4 years, and they started laughing. They started laughing at me. I said, hold on, I'm not done. I said, that was the earliest. And I said, it's probably out to 10. They're like, yeah, at least. So if you really kind of consider reality, we are not in a paradigm where we're going to go back to 2% inflation. We're not. It will happen down the road at some point. But unless we have a COVID lockdown, it's not going to happen. What's going to happen is we're going to have persistent, higher than normal inflation. It may end up being 5 or 6. It's not 2. Even 5 or 6 is a problem, right? I'm not saying it's going to go to 10 or 20. It could. I mean, with the government, who knows what's going to happen? But I think assuming that inflation gets under control, which I think the Fed has adamantly said that they're going to keep things under control. And I do believe them, because if they don't, the other situation is a lot worse. Hyperinflation is worse than World War III. I know you probably don't believe me, but it is definitely worse than World War III in the impact that it will have on the total war, on the total globe. But the point I'm making is that it's not going to end early. So you have to hunker down and prepare for it. And some of the things that Doug said and I've said earlier in this show are ways to start to do that. And we'll talk more about that. But effectively, one of the reasons that this is happening, I'll take it to a baser level, is there's too few goods for too many people, right? And there's too many dollars for too few people, right? Those are all impacts. And we talk about this a lot in the show, is inflation versus price inflation, commodity inflation. Those are all different kinds of inflation, but we have inflation, and you need to prepare for that. So what are your thoughts, Doug? I just went
Well, I
rant there.
mean, yeah, no problem. My thoughts on that is like you just said, you have confidence that the Fed's going to do this. I mean, I think first of all, as I mentioned in a previous podcast, Chairman Powell came back from Jackson Hole angry because he said, "Look, I'm going to fight inflation. I'm going to do everything I can to slow this economy down, to get that money, that M2 money supply out of the system." And then as the economy started to soften, as it was going to with rising interest rates, I think people started to predict, well, see, he's going to back down now and he's going to lower interest rates again. And he came out and said, listen, nobody's listening to me. Okay? I'm going to do this. So if you're not listening, there's plenty of products. You can go to the drugstore right now, clean your ears, because it's out there and it's loud and clear. I think the other thing too He mentioned Volcker's name several times in that meeting. He doesn't want to be Volcker. So you mentioned, Kirk, that okay, we're going to go back, go back in history and say, all right, well, the government said, well, we don't have inflation. Oh, it's transient inflation. It's whatever. Okay. The reality is that he has said, I don't want to be Volcker. And what happened in the 70s is is that prediction. Every time rates went up, inflation started to temper. Oh, we're out of it now. Let's calm down. And then what happened? Whipsaw. It was like it was an interest rate inflation bullwhip effect in the 70s. He doesn't want that. So he's predictably not going to admit that we have tackled inflation, that we are in a recession, until the entire world is slapping him in the face and telling him we're there. It's going to be so obvious to everybody, but they're not going to admit it because they do not want to make a premature reaction to it that ends up defeating the cause. And what you just said is, as long as they stay true to that mandate, at least you can prepare, right? It's the unpredictability, I think, of the 70s and the oil embargoes and all those things that made it even harder. As long as there is, listen, any plan is better than no plan, right, Kirk? As
Absolutely.
long as they have a plan and they stick to it, then everybody can adjust to that. And I think that if there is one thing so far to respect about what is the current Fed administration, is that they're trying to tell you, we're not just going to be whimsical about this. We've got a plan. Plan may work. Plan may not work. We think it's going to work. We're going to stick to it. And as long as people are consistent in what they're telling you they're going to do, then you have plenty of time to prepare for it. So as I said, if you're not listening, clean out your ears. If you're thinking this time is different, it's not. There's an old saying, Kirk, follow the Fed, right? Follow the Fed.
Don't fight the Fed.
It's always worked. Don't fight the Fed. Well, don't fight the Fed. The Fed is the one thing about the Fed, unlike any politician, the Fed puts their transcript right there out front, said, here's what we're going to do. And yet what happens? Nobody listens to it. And it's the only thing out there that's ever been published in advance to tell you exactly how things are going to end up. And we're right where he said we were going to be 6 months ago. I'm going to start raising rates. Is this a surprise to anybody?
Well, I want to touch on that, Doug, because I think you bring up a great point that we need to illustrate for the listeners here. So the Fed, one of the Federal Reserve's strongest tools in managing, managing the things they're trying to manage, right? People think, oh, they're managing the money supply, they're managing interest rates. They manage a whole lot more than that, and they don't say it. And the reason is their major tool that they don't really talk about is influence and persuasion. Their job, I'll give you a great example of this. 2020, they came out and said, we're going to support the markets during COVID, right? Which was the right move, right? Because frankly, the markets could have gone to zero. When the whole world shuts down and nobody's working, frankly, you do that for a while and it really does go to zero, right? But of course, that's not reality. And the market knew that. However, what the Fed did is they came in and said, we're going to support the markets. We're going to buy what we need to buy. And they were also concerned about the high yield bond market, which has actually been a very well-known problem for many, many years. And the concern is, it's actually greater, and we should have an episode on this. But the basic concern is that if things get bad and high yield bonds start to default, it causes what is normally an illiquid market. It's really hard to buy and sell high yield bonds. A normally illiquid market to freeze up, and then you can't get your money out. This happened, I think, 2017, I think is when it was. It's happened before. 3 funds, 3 days in a row, froze up because oil prices started to drop and they couldn't sell their high yield bonds. So they're effectively worth zero. They're not worth zero, but if nobody wants to buy it, they're worth zero. So, these things happen. So the Federal Reserve's aware of it. So what do? We're going to buy X, I forget the amount. We're going to buy $100 million or $1 billion worth of high yield bonds as necessary to support the market. That's what they said. They said, we've taken this money, we're putting it aside, and this is what we're going to use to buy. Maybe it was $100 billion, I don't know. We're going to buy $100 billion worth of high yield bonds. And the market said, awesome. So they started buying high yield bonds. You know how much money they bought of high yield bonds, Doug? Zero. None. They didn't have to. The market did its job for them. right? The market went in and bought ahead of the Fed, and they pushed up high yield bonds to a premium in many cases. It was crazy. But that was because the market was expecting the Fed to support it if it crashed. So there was really, quote unquote, no risk to the market because the Federal Reserve was there to bail them out. This is what the Federal Reserve does a lot, is they come in and, quote unquote, bail out the market. So people know this and they front run the Fed. So what ends up happening is over the last few decades, the Federal Reserve has trained the market participants, the institutional retail investors, they've trained them that if the Federal Reserve comes in, everything is going to be okay. Because, hey, the last 20 years have looked like this, so why wouldn't the next 20 years look like this, right? What do we call that? Recency bias, right? We talk about cognitive biases on the show. That's looking at the recent past and saying, oh, the future is going to be the same thing. Well, that's not how it works. And we're in a new paradigm, so you cannot expect that to continue. And the Federal Reserve has clearly stated, and believe me, I know people listen to the show do not like the Federal Reserve, and I'm certainly not their biggest fan either. But, we have to be pragmatic, right? We have to look at it and say, all right, what is the right thing to do? Do you want to be right or do you want to make money? Right? I could not like the Fed, but I want to make money, right? That's my job, is make money for clients. So it's not about being right. And so in order to look at what the Fed's doing, we have to analyze what is in their best interest. Well, we know the chairman is sitting there saying, I want to be a Volcker, not a Burns. We have the markets that are saying we don't want hyperinflation. Everybody knows it's a terrible scenario. But we have the politicians saying, hey, you need to ease up so we can get reelected, right? Politicians are not always going to win, but they're certainly going to make things worse for a lot of us because they want to get reelected. And we've seen that in the, leading up to this election, quite frankly. We've seen a lot of it. So I think that the takeaway here is that you have to reassess all your assumptions. You can't assume just because the Fed came in and bailed everybody out that it's going to happen every time. There's this concept we call moral hazard. I've written a good blog post about this. I'll put it in the show notes. But moral hazard is one of the reasons that the great financial crisis happened in 2008. So, we'll talk more about that on the show too, because what they're doing is they're changing what that looks like. And what people need to realize is they need to realize that you cannot make those assumptions that, hey, the Fed's going to lower rates, they're going to bail everybody out. That is a good indicator. I will tell you, if the Fed comes in and says, hey, we're going to lower rates, that's a good indicator that you should probably go long. But I think, quite frankly, with what we're seeing now, the most likely scenario is they raise it to a certain point. Goldman Sachs just came out this morning and said they're gonna flatline it around 5%. I would say, yeah, you said that at 4%, you said that at 3.5%, you said it at 3%. The numbers are just going to keep going up until they don't. And whatever that rate is, it might be 6, might be 7, might be 5. I don't know. But I know that wherever it is, it'll probably flatline around there for a while until we start to see marked improvement. And just one more point, and I want to let Doug talk about some of these charts we have. I think what we need to recognize here is that, with the inflation that we have, we need to hunker down for a few years of this. And we need to accept the fact that inflation, while it may ebb and flow, the new equilibrium may be higher. And you should just prepare for that. And so, Doug, let's talk a bit about what do you want to talk about, Doug? You want to talk about the Meta Facebook chart? Because I thought that was really interesting.
So, no, I think that's a perfect segue, because I was going back to kind of what you had mentioned earlier about QQQ and how much it blew up in 2000. And actually, there's another chart that I just that we've got that we can also put out there. But it turns, as a story of what has gone on with technology. And I've said this before, technology has got two things that go really well for it in a thriving economy. Number one, as a sector, it's still very much driven by advertising. Okay, the money, in whole, technology is driven by easy money, right? So if it's an advertising-based technology platform, like Meta, for example, you're going to have the benefit of lots of free money from companies that are trying to get recognition, branding, or reach, right? That was Meta's big platform to monetize all that. And they've had some significant changes with Apple that has made it difficult on them as well. But just economy wise, as this dries up, as companies start looking at their bottom line, they may spend a little less in areas of advertising. The second thing is technology is very capital intensive. You've in order to continue to get the server space, to be able to not crash your website, to be able to make sure these companies run, technology is something that has to be heavily invested in. It is a loss for most companies. Okay. It is considered an expense category. Sales is considered a profit category. Salespeople go out there, they generate business, bring money into the company. Everything else eats off of that income. So as you start to see the economy slow down, you start to see companies make less investment in technology. And the third is also not a lot of technology companies are speculative based. We think it's going to be a grand idea. It creates convenience. It creates this wonderful opportunity for our future, but it doesn't mean it's profitable, especially in the beginning. And so what happens again is that in order to go from a startup of 5 people, and we're not in the heydays like remember the dot-coms where 5 people would have an idea and 5 weeks later it would sell for $5 billion and all that money have just eviscerated, but or evaporated, whatever the word was today. It's Monday. But point being is, you take a company of 5 people and you expand and then you start to get traction. You got to invest millions, if not billions of dollars to build that company. And it takes years. Tesla wasn't profitable for years. Amazon wasn't profitable for years. Uber will never be profitable, I think. Facebook wasn't profitable for years. Google really is one of the exceptions here. Google Alphabet was profitable so early on, but because of their search engine platform, they were just perfectly positioned to capture money off of every transaction. Okay. Kind of sounds like some of the brokerage industry, but anyway, I digress. But the point is that we are in a time in which capital has dried up. I just mentioned 7.6% for a car loan for a high credit score, incredibly responsible financial client. They're not giving money away. And that means that companies like SoftBank, which had all this money that they were just throwing at duds left and right, just hoping. And that's the whole idea with technology, was that you could spend $100 billion as an investor and hope that one company would become the Uber. As bad as it is as a company, it was a good stock for a while, right? Or it might become a Facebook, or it might become this. But once that money dries up, it becomes very, very difficult. That's why you're starting to see this freeze on the on technology and the NASDAQ and such. And I actually sent something over today that, somebody wrote that basically Warren Buffett must be right, because during this entire economy where we've seen just a massive slide in the valuations of tech stocks, Berkshire Hathaway is down, I think, 5%. Okay. So it's holding on to real capital, real goods. So going back to the chart you're talking about, and I remember this reminds me of when Facebook went public, and a friend of mine who wanted to buy Facebook shares. Facebook went public, spiked, and then it tanked. Okay. And this person got out of it. And of course, then Facebook became wildly profitable and wildly successful. And, looking back, hindsight was like, darn, should have held on to it, right? Here's the reality now. It is so bad right now what's going on in terms of Meta that it actually, if you go on a total return basis since the IPO, lump sum investment, it's now underperforming the S&P 500 since it went public. I mean, Zuckerberg's net worth is down. I think last I heard, it's down to only 40 billion. So, if anybody has any extra cups for the food line, Mark, I think, is looking for a couple. But in reality, I mean, he's lost half his value. And I'm, just looking at the value of how much it was up. I mean, at one point, Meta was up, 1,000%, right? And now it's down to about 251%, which is, I mean, you still made money in it, but that depends on when you got into it, right, Kirk? This is since the IPO. The S&P 500 is up about 225%. So, it's a very volatile industry to be in. And yes, technology drives our world and is going to be continued investment in technology. It's an incredible holding, but I think it's just another argument of why you got to diversify. And what was happening in the last several years is that people didn't realize the S&P 500 was driven by the FANG stocks. As the FANG stocks performed, so did the S&P. And ultimately, people say, well, I'm diversified. I got 500 stocks. And the reality is not true, because the way the calculation of the S&P 500's value works, it is actually a component of the fastest momentum stocks in it, which meant you could hold the S&P 500 and really only be holding 5 to 10 stocks. And that's pretty scary when you really think about understanding. And I'd argue we're seeing a significant lack of understanding of what people really know and understand about diversification.
Yeah, it's some great points, and I'm gonna bring a lesson in here that I think is really valuable. So I think just for reference, and Facebook actually just came out with earnings last week, which the market didn't seem to like. I think it was down like 20% after earnings, after releasing it. So it was a rough day for them. But I mean, looking at it right now, it's down around 75% from the peak, which is not insignificant. If you look at the Nasdaq in the early 2000s, I think it was down 70 some odd percent. I forget exactly what it was, but it was at least 70 from the peak. So I think, this is a lesson that we can all kind of take away from this, is that if there are tech companies that are not profitable, you might want to put your money elsewhere. If there are large companies that are profitable, some of them are going through tough times. I would just be patient. I mean, I remember Microsoft as an example, great company. They went through some times where they had a rough CEO that I guess some of my friends that work at hedge funds used to tell me is like, well, when we build our models, we build in like that they're going to destroy about, I forget the number, it was like $100 billion a year in value. So whatever they were modeling, they assumed they were going to take $100 billion and light it on fire. That's basically what they told me. And I was like, yeah, that makes sense. They acquire companies and then the companies don't do anything. Their new CEO has done a phenomenal job. So kudos to him, because he's really turned the ship around. I've noticed, a lot of their products and what they've done have really improved. But that's not my point. My point is that if I look at, and I'm sure I have clients with that position, so just as full disclosure, the point is what I'm really talking about here is that there are times when you want to be buyers of tech, and there are times where you don't. Right now, you probably want to sit in the sidelines. There will be a time where it'll make sense to get back in, but if you're trying to pick the bottom, good luck to you, because no one has been able to do that successfully since the beginning of time. So if you're the first, give me a call, let me know your secret, because nobody else seems to know how to do it. So I wouldn't suggest it. I would suggest just being patient with tech. There will be a time. What I would suggest is put together a list of all the companies you want to buy, ideally ones with profits, all the companies you want to buy, and wait. Just wait. If you look at any market, when there's a sell-off, there's this kind of concept. I forget who wrote it. He wrote a paper a while ago called the guillotine and the sandpaper, which is, the guillotine is when the market sells off harshly, and then the sandpaper is this back and forth action that chops everybody up and causes people to lose more money. But really, if you look at any sort of bubble that pops, once it pops and it kind of bottoms out, it flatlines for a while. You'll have plenty of time to buy. You'll know where we're at a low. There's a certain point it doesn't get lower. It just kind of bounces around within a low range for a long period of time. And then eventually things start to pick up. Just wait. Just be patient. This is what I said before. Like, if this lasts 10 years, you don't have to worry about picking the bottom now. Maybe the Fed lowers rates and things change, but assuming they don't, you've got a few years, right? So just be patient, pick stocks. You don't have to only buy tech. There's also other stocks in the S&P 500. There's industrials and financials. I know they're not sexy. They're not going to change the world the way tech is, but they also make money, believe it or not. There's energy companies, which probably the only sector that's actually making money this year, but people don't like it. It's not green, whatever. We haven't invested in energy in 20 years. So we're not going to start now. Whatever your reason is. The fact is they're making money and they're up this year. So just open your lens a little bit wider, widen the scope, look at other things that you may not be comfortable or familiar with, and realize there are, and I hate to quote Jim Cramer because everyone's just tearing him apart, but he's like, there's always some place you can make money. I'm paraphrasing because I forget what he said. It was something like, there's people are making money somewhere, or always making money somewhere. And that's the truth of it. There's always a way to make money somewhere. It's just a matter of where, and are you proficient at it. But I do want to talk to this chart a little bit, because what it says is if you invested $1,000 a month since the IPO, you would have underperformed the S&P at this point. Now, I don't point this out to point out how bad Meta's doing. I think that's all pretty apparent. What I'm using this chart to point out is that you could have still invested in Meta. Buy and hold for the long term doesn't mean buy and hold and ride it down to zero. I'm not saying they're going to zero. I want to caveat that. But you look at General Electric as an example. For over a decade, it was considered the best company in the world. They were AAA rated. And then during 2008, they almost went bankrupt, right? And AIG during the financial crisis, another AAA rated company. I don't remember the caveat, but virtually went bankrupt. They got bailed out. But the point is all of these companies, no matter what their ranking is, they don't last for eternity, right? I think GE was the final Dow component that has started from the beginning. Everything else.
And Kirk, I wanted to add in there, GE's never recovered from
right.
it. Yep.
Right. And a lot of fundamental analysts say they never will recover. But the point, your point's valid, Doug, is that, companies do not last forever. There's a reason the Dow changes companies all the time, and there's only 30 stocks. And GE was the last one from the original Dow. But the other ones either merged, they get acquired, they went bankrupt. So many different things happened to them. And so you have to realize that buy and hold forever is not a strategy. So I bring this up not to say that Meta is good or bad, because I don't know at this point. I have my reservations, but I point out because there's many ways to manage risk. We talk about risk management in the show a lot. There's many ways to manage risk. This way, there's one simple way to manage risk on any stock you hold. Okay. This is something we use, things that are a little bit more complicated and require a little more understanding of the financial markets to manage risk. But you could use something simple. It's called a stop loss, right? And there's multiple ways to execute stop losses. One is you pick a price and you stick to it, right? You just say, if it goes below this price, I'm going to sell it, which works, right? You buy it at 10, it goes to 15. You say, all right, if it goes below 10, I'm going to sell it. Okay, good path. But what if it goes to 100? You still going to stick to your 10? Probably not, right? So there's things they call trailing stop losses, which I think are a lot more effective. Now, a trailing stop loss, the way that works is you decide that I'm going to have a stop loss. And let me just take a step back. What a stop loss is if the stock starts at 10 and goes to 15, and let's say you put a stop loss at 10, let's say you put it at 12. I don't want to confuse people. You put it at 12. So if the stock goes from 15 and hits 12, then your position will be sold. So you put an order in the market. It's called a stop loss order, which means that automatically, no matter what happens, if it hits 12, it will be sold for a price around 12. Let's just keep it simple here for the example. So no matter what, if it goes down, and this isn't a crash scenario, this is a normal market. If it goes down, it will trigger at 12. So you're going to protect your gain of that $2, which is the whole point, right? It could go to zero after that, but as long as you've sold at 12, you've protected your original investment and your profit. So a trailing stop loss, the way that works is as the stock keeps going up, right? As it continues to go up and up and up, as things have in the last 20 years. And let's take Meta example. I think it topped out around 384 and 33 cents, I think is what I have on my chart. So that's the top. And let's say you had a 20% stop loss. So once it hits that 20% loss, then your position's sold. And yeah, you have to pay taxes on gains. And yeah, you're probably saying, oh, I wish I held on to it. It's going to go higher. But you know what? It's down around 75%. You're wishing you sold it when it was only down 20. And I also use this as an example because a lot of people think, well, I've lost 20 to 30% of my portfolio. I'm just going to hold on till it comes back. This is the reason you don't hold on until it comes back. There's a reason you put in risk management. It's because your brain is not going to protect you in the stock market. If anything, it's going to do the exact opposite of what's going to make you money. That's kind of a cardinal rule in the markets, is the stock market will do the exact opposite of what you think it's going to do, and it's going to do the thing that's going to cause the most amount of people to lose the most amount of money. That's just the general theme of how it works. You have to keep that in the back of your mind. It's not actually thinking that, but that's how it typically operates. Is market movements, whatever everyone thinks is going to happen, it'll do the opposite. So just keep in mind that stop losses will protect you. It will protect your capital. It will protect your gains. In the case of the last, 14 years, a lot of gains. And don't be afraid to get out and sit in the sidelines. Don't think, oh, I lost 20 or I lost 30, so I need to stay in to make it back. That's the gambler mentality. I'm going to make it back. I made $1,000 in casino and I've lost 200. Oh, I got to make it back. You're not going to make it back. You're going to lose it all. That's what happens. You need to, I'm not saying it's in every case, but this is how you have to think. You have to think risk management first. How can I protect my capital? How can I protect my profits? And then if you miss out on upside, who cares? So you miss out on another 10%. Who cares? That's money you didn't have anyway, right? You made money on the upside, it hit a peak. And Doug, I have to ask, why do people always look at the peak and say, "Oh, I've lost from the peak"? Who cares? What
Well,
does that even
Kirk,
matter? It's money you didn't even have.
that's because they bought it at the peak.
Let's hope not. Our listeners are smarter than that, Doug. We have
All
really
right,
smart
that's
listeners on
true.
this
That's,
show.
if you're listening to this, you're better than that. And I'd like to add something too. You're talking about stop losses, but I think this is very, very important for people to understand. If you're an amateur that's trying to do stop losses on your own, be very careful. This is where I really recommend working with a professional, and also especially if you're looking at ETF stop losses. Stop losses on stocks is, you can have a stop drop by 20% one day. You just mentioned that about Meta. But yeah, be very careful about ETFs, because what happens with ETFs is you still have a market maker. I don't want to get too in the weeds, but basically an ETF is a collection of stocks. It's very unlikely that every stock in an ETF, for example, the Spider Retail ETF, it's very unlikely that that's going to drop 10%, that every stock in it's going to drop 10%. If you get a massive drop like that in an ETF, unfortunately, a stop loss could sell you out at the bottom, because what's likely going to happen in those cases, it's probably going to come back because there's something like, maybe, I think this happened in 2010-ish. Somebody one of the big institutional firms fat figured a trade, and all of a sudden we had the flash crash, right? Boom. Everybody was out. ETF came back. So I just want to make sure that people understand, if you're going to be looking at those, I think stop losses are incredible, but that's where I would recommend working with a professional on them to understand some of the technical and fundamental things behind that before you just go play with it, because there is a lot you need to know about them as well.
Awesome. So, Doug, I want to touch on one quick topic. I want to get your thoughts on it, and we'll get close to wrapping it up here. I want to talk about the Baltic Sea Index, a Baltic Dry Index, as it's called. And what this measures is it measures shipping rates. So people use it to pretty much navigate the kind of shipping industry and see what's going on. It peaked last year. It looks like around October, and it's down quite significantly. I saw a report on Twitter, which of course must mean it's true, is that pretty much that we're not seeing any traffic on the ports. So remember, in the last few years, ports were backed up for like months. And I've heard this a few times. Of course, it's hearsay because everything's wrong on the internet. But what that means is if there's no traffic, no backup, it means that that shipping's down a lot, which is good or bad. But it also, China still has their zero COVID policy. Now, I wanted to bring this point up because we're talking about when inflation is going to end, and I bring this up because, if you think about this, the world has a demand for, let's say the world produces 100 goods, just to keep numbers simple. And, we have 100 countries and only 90 of them are buying. You're going to have a certain equilibrium for price. But let's say that other extra 10 countries come back into the mix, they start buying. Now there's more demand for the same amount of goods. Now, China has been virtually locked down for a while now. And inflation, I wouldn't say is tamed, but it's not accelerating, which I think is a good thing. Even though it's high, it's better that it's not continuing to go higher. But um, we're starting to see some signs that maybe inflation might come down a little bit in the next few months. I'm not convinced either way, but it looks like, it could start to drop a little bit over the next, 3 to 6 months. However, if China decides to open up their country and say, we're no longer doing zero COVID policy, that's going to open up a lot more people to buy goods and services. And yeah, I think it may accelerate inflation. That's if you think of all the factors that go into this. We talked about it earlier. All the factors that go into inflation. This is one factor, right, of many. You have other countries that are claiming that they're going to give more money out to the people because they're going on hard times. That's inflationary. So there's a lot of reasons why we talked about last week. The U.S. dollar is strong and other countries are not. But you have to keep in mind that there are other factors that are going to come in and drive up inflation, even when you think it's going to start to decline. That other things like China might open up. So I just bring it up because I like looking at the Baltic Dry as a macro indicator. I'm not sure you can derive any short-term profits from trading this or where it's going, but I think it's instructive because there have been times where it's really low, and then you look at it and say, "Ooh, that's interesting." I think it was probably like 10 years ago or so when the Baltic Dry was like at historic lows, and they were giving away ships. Like there's all these ships that they weren't using, just sitting there, and you could get them dirt cheap. And then you look at like last year where there were, I don't know if it's historic highs, but really high in comparison to where it is now. And obviously fewer people are shipping stuff if it's too expensive. So I think it's just important to look at different metrics, not to say, oh, because this is one thing a pet peeve of mine is somebody will put out a chart and say, look at this. This is the reason why I'm right. Yeah, but what about the other 50 things that are pointing the other direction, right? Oh, well, those are wrong, right? It's like this, people need to be right.
Well,
And,
we've talked about that before. You can take the same chart and both people you can use it to convince you that their argument was correct.
Right. And actually, we're going to talk about a lot of those half truths next week because there's a lot that I think you really need to understand. So we'll get into that next week. But Doug, what are kind of some of your thoughts on this as we kind of wrap up the inflation topic?
Well, it's interesting because it does kind of reflect what we have. I think back a couple weeks ago, we had posted a chart. It's probably it's a Bloomberg chart, and it's probably the largest and worst index name I've ever seen. It's called the WCIDSHLA index. And it's the WCI Shanghai to Los Angeles Container Freight Benchmark. Anyway, it went from it went from 12,000 down to 29.95 in a matter of about well, I mean, since it was at the peak right at the beginning of end of 2021, beginning of 2022, up until recently, and I can't remember the date that this was posted through. So it's probably right through mid-April, but I mean, it's down 75% from its peak. And so this is the cost to ship a 40-foot container from Shanghai to LA. And it's fallen by 76% from its peak, which is the largest decline in the history of Ceres. Now, if you take a look at the chart you just posted, very similar to that, right? We're seeing a massive correlation there. The Baltic Dry Index, much easier, BDI, is showing a very similar metric. So you're seeing that lineup. This is bullwhip effect, people. I mean, I'm sorry, you mentioned Kramer earlier. It's just like I wish I had a button here to, to show that whipping sound. I'm not gonna, and I'm not no the whip sound, but I'm not gonna make that sound here. I might scare too many people, and even though it's Halloween. But the point is, we have seen a slowdown that has come because the interest rates went up. That means, I mean, let's face it, people buy a lot of things on finance, especially bigger goods, things that get shipped. You know what? Ranges, TVs, couches, furniture, things like that. All of these things get financed. And with that financing being so much more expensive and a concern about the economy, you're naturally seeing a slowdown. But you just mentioned something I think is really important. This is an example of bullwhip. China hasn't been buying yet. Right now, Chinese people may not be sitting on the same cash that American people are sitting on, thanks to that COVID MEM2 supply. But whether or not they have the same amount of money in their pockets overall to buy as we do here in the United States, you add a couple billion people freely purchasing in ways. I mean, let's face it, 2021 was reactionary, right? Things freed up and everybody went crazy. Like, I am ready to go invest. I'm ready to go buy. I need to do these things. I've been cooped up. You think we were cooped up here? You have no idea what it was like to be in other countries. And we really do take for granted. We say, oh, how imprisoned we were, how free we are compared to what's going on in other parts of the world. And so if China adds several billion people on the demand side, and now bullwhip effect, right? Huge, couldn't get enough, huge purchasing. All of a sudden that purchasing started to wane. Now they're trying to meet that bullwhip effect by slowing down shipping, right? And all of a sudden you add $2 billion more to buy. Get ready. Back and forth. That's my little taste of it today.
So, Doug, where can people find more about you?
I appreciate you asking, Kirk. You can find more about me at ProCollegePlanners.com. And here's the thing. It is college planning season. This is what we specialize in. If you think inflation's bad in the everyday, listen, if what you thought you knew was true turned out to be untrue about planning and paying for college, when would you want to know? And that time is now. If you have any high school children planning to attend college, you don't want to miss a live presentation that we're doing every week. We actually have one tomorrow. If you go to ProCollegePlanners.com or reach out to us at info@ProCollegePlanners.com, we can get you the link. We're also going to continue to do this periodically. We've got another one next week. But here's the facts. Only about 3% of people who have graduated have actually achieved an extraordinary future from that college. They've surveyed. Gallup and Purdue did this survey of thousands and thousands of graduates. And they look back and said, look, we didn't really get the experience that we thought we were paying for. Only 3% did. So we call this the exclusive 3% club. If you're going to pay $50, $100, $200,000 for college, first of all, you don't want to overpay. Second of all, you want to get a return on that investment. And that return on that investment is knowing that you paid the right price to send your child to a great school where they're going to have an extraordinary future. And if you want to be part of that 3% club, you got to make the investment. You got to do the right things. Find out more at ProCollegePlanners.com. Join that exclusive 3% club.
Great. Well, Doug, once again, always love having you in the show and getting your insights here. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.